From the beginning of time, man has always had a pursuit of the best quality of life possible. That quality of life is not possible without resources. The form of resources we have accumulated has changed over time from cowrie shells, state-controlled money, precious metals, real estate, and stocks and bonds. Over the past 100 years, the world has been dominated by the US dollar and its reserves. But everything that has a beginning also has an end. A new financial revolution is upon us with the emergence of a digital economy. The way we earn, spend, and accumulate resources is fundamentally changing. A new asset has appeared that the wealthy have overlooked. Bitcoin has become the best performing asset of the past decade by far. With only 21 million ever in existence, there are more millionaires and billionaires in the world today than there are Bitcoin. Just by holding 0.25 Bitcoin today will put you in the top 1% asset holders in the world in the next 5 to 10 years. If you would have invested $100,000 in Bitcoin in 2013, today it will be worth more than $15 million. Bitcoin billionaire Raoul Pal says, Bitcoin's performance is so dominant and so all-encompassing that it is going to suck in every single asset narrative dry and spit it out. Never before in my career have I seen a trade so dominant that holding any other assets makes almost no sense. This is not an industry you can afford to ignore. If you want to remain in business, then you must adapt. Are you offering services in Bitcoin? Are you accepting payments with digital currencies? Have you adopted blockchain technology? Blockbuster Video at one point was the most dominant video service in the world. They had the opportunity to be part of Netflix, but they ignored the changing technology. Where is Blockbuster today? Where will you be tomorrow? Imagine a world where everybody is connected. Imagine a world where somebody in Japan can do a transaction with somebody in the United States without high banking fees. Imagine a world no longer ruled by greedy corporate banks. There's going to come a time when we think of central banks in the same way we think about calling an operator to talk to a friend on the phone. This weird, annoying entity that came between us and the things we actually wanted. You aren't going to drown in fees anymore. You aren't going to borrow money from a bank. You aren't going to fight a half a dozen middlemen. It'll just be you and your money anywhere on earth. And once this happens, cryptocurrency could very well make the US dollar obsolete. Once people understand how easy this is and get used to it, the demand for legacy money controlled by a government and bank is going to plummet like a rock. Welcome to the world of cryptocurrency. All right. Good morning, everybody. Welcome to Early Morning Crypto Talk. Bitcoin Brandon from Los Angeles, California. I'm the founder and CEO of Ivy League Crypto Academy, ILCA for short. Go ahead and type your name in the chat box where you're listening in from. As a disclaimer, I am not a licensed financial advisor to be giving financial advice. I read the news, share information for entertainment, training, and educational purposes only. And it is up to you to make your own informed, intelligent decision on which direction you want to move into. Now, we're doing a special modified crypto talk today. Normally, I do this just for my inner circle, but this is also 5-day challenge week. We have a special panelist tonight, Professor Oscar Sistrunk from Morehouse College, will be sharing some special graphs on the Bitcoin halving events that take place and why they're important, why we should pay attention to it. Also, because we have a short period of time, a window that's getting smaller and smaller every day, where we are sitting at the beginning of a revolution, even inside of the crypto space. We're starting to see what the future of crypto is going to look like. You know, before we've been in this wild, wild west gold rush, where another way to think of it is the electricity race. If you ever saw the movie that talked about how Thomas Edison was competing with Tesla and about were we going to use AC or alternating current, or I forgot the other one, DC current. And there was a race going on at that time. And the winner was going to end up shaping the way the rest of the world would be developed. That's happening right now in the financial space, where it's still unknown exactly what the future is going to we know the future is going to be different. It's going to be radically changed from now, but we're still at that beginning where it can kind of go any way. And I'm starting to see a clear picture on where that's headed, and it's going back. It's like a full circle. Crypto started with Bitcoin, but Bitcoin at the time was not designed to be able to do for mass adoption what the world needed it to be able to do. So altcoins spun off from it. And Ethereum stood out to be that token that allows businesses to be positioned using this new technology with smart contracts and NFTs and tokenization. But that has a lot of problems as well. But we're talking about almost $100 billion worth is sitting in that space and growing. Now we're coming full circle where technology is bringing us back to Bitcoin for technology and outside forces like the SEC and different governments and regulations. It's forcing everyone back to Bitcoin. So when these articles popped up, and I got to give it to Miss Marnita Casa for finding these for me. When these articles popped up, this is a perfect opportunity, a learning moment for all of you to be able to tell and differentiate what is Bitcoin, what is Ethereum, and what is this Bitcoin Lightning Network that we keep hearing about? Why is it so important? Why should we understand it or pay attention to it? And so I'm making this open to the public because I do have an audience outside of my ILCA community that needs to know this information. They may not know they need to know it, but they do. They need to know it. So thank all of you guys and congratulations for showing up this morning, for taking a listen to see what's going on here. So let's do a quick roll call. I see we've got Neil Brooks. Good morning, Neil. And also, this is streaming on Facebook, YouTube, and Twitter. If you want to share this on your Facebook page, just go to my Facebook wall and share the Facebook stream. I see Marnita Casa on the line, Joyce Easley, Shauna Ross. Let's see, Mr. Albert, Sue Williams, Martha from Mexico, Janelle from Colorado. Good morning from City of Hope. Is that you, Mike Nowalski? Jersey? See, Kevin Strouser from Georgia. Carla from Missouri. Adele. Colin and Adele from Trinidad. Wild Bill from St. Charles, Missouri. I like that name. What's going on, Wild Bill? Sonia Elaine Barr from Plantation, Florida. I see you, Dagmar Sabat, as well. So good morning, everybody. So we're always going to first start it off by, we're going to read the chart. So let me go ahead and share screen here. Oh yeah, I'm on StreamYard. Okay, it's a little different. All right. So let's see what's going on in the crypto market this morning. Okay, this is slightly up from yesterday. Crypto market cap is at 1.08 trillion, up 0.4% in the last 24 hours. Bitcoin dominance has fallen. It was at 47.4% yesterday. Now it's 47.1. Ethereum dominance has risen. It was at 17.3 yesterday. Now it's at 17.6. Okay, let's see. There you go. Bitcoin's flatline while Ethereum rose. So it's important to know how to read the charts. You can figure out what's going on down here just by looking at this. Let's see. Ethereum is at 0.6. I see you, Melanie Davis. BNB is up slightly, 1.2%. Ripple's up 1.1%. Tron's 0.6. Toncoin's 1%. Matic's up 0.7. Bitcoin Cash is up 2.1. Opposite here, Leo tokens down 2.8, and then Avalanche is up 1.9. I don't see any major outlier. Hedera went down 1.8. Internet Computer, Lido, Aptos. Okay, let's see. The best performers in the last 24 hours. Maker up 4%. Whoa. That's a cup and handle. Frac shares up 3.7. Bitcoin Cash 2.1. Avalanche 1.9. Ripple 1.1. Ripple got back above 50 cents. All right, the worst performers. I see you, Jamal from Pasadena. Roll Bitcoin is down 5%. Immutable X down 4.3. Leo token down 2.8. Quant 2.7. Mina Protocol 2.2. Render 1.9. Aave 1.9. Hedera down 1.8. Okay, nothing really out of pocket. Looking at the news to see if there's anything major. I see the UAW is striking. The Writers Guild ended their strike, but you still have the Actors Guild is still striking. So that's only breaking news that I see. We're getting close to a government shutdown. There's chaos happening in Congress. We have to keep a close eye on that. That will impact the market. Not a matter of if, it will impact the market. So we got to keep a close eye on that. The last government shutdown, what was that? 2019 cost $11 billion and it was just shut down for, I think, 36 days, something like that. So we got to watch that closely. And I want to see how, since we're in political season or election primary season, how do the politicians play on this? The government shutdown, the strike, what stance are they going to be taking on this? Okay, now let's go into this article. Bitcoin versus Ethereum. Key differences between Bitcoin and Ethereum. I did a lesson for WGC last night, and I was talking about how to build your crypto portfolio. And there was a little bit knowing the difference between Bitcoin and Ethereum. And if you guys read the white papers, you understand. You know, the founders of Ethereum were all on Bitcoin. And they decided we can do something better. And we can do something a little bit different. They created Ethereum. The co-founder of Ethereum went on and created Cardano, ADA. Bitcoin had a soft fork that created Litecoin. Then Bitcoin forked one time later called Bitcoin Cash. And then Bitcoin Cash forked into Bitcoin SV. And so there's always improvements on technology. It's just like when the internet first came out, we had AOL dial-up internet. You couldn't be on the phone and the internet at the same time unless you had more than one phone line in your house. Then we went from that to they had fiber optic cable. They said we want to have high-speed internet service. Then it went from that, then we went to now we got Wi-Fi, where we're able to stream videos and high amounts of data instantly without any lag or anything like that. So technology always builds on. So Bitcoin was the first, which means it's going to be improved upon. But let's see what's the key differences between Bitcoin and Ethereum. Bitcoin and Ethereum are arguably, it's not even arguably, it is the two most popular cryptocurrencies out there and have greatly contributed to the sector's growth. Bitcoin was the first cryptocurrency ever to be created and is seen as as digital gold or gold 2.0, while Ethereum can be seen as a decentralized computer for the world. That's a good way to put that. A decentralized computer for the world. Bitcoin is seen as digital gold because it is scarce and durable, like the precious metal, but it can be easily stored and divided. Ethereum is seen as a decentralized computer for the world because the network is used to run decentralized applications, dApps, meaning applications that aren't under the control of a central authority. So everybody knows the word apps because you got apps on your phone. Well, the crypto also has apps, but they're called dApps because it's decentralized. It's not controlled. See, wallets, when measured in various metrics, Bitcoin and Ethereum are the top two cryptocurrencies. These metrics include market cap, unique wallet addresses, and trading volume on crypto exchanges. Market cap or market capitalization or market cap refers to the total dollar value of a cryptocurrency's circulating supply. So if you go to CoinGecko or CoinMarketCap, you'll see MKT cap for every single coin. That tells you how much volume is sitting there. So Bitcoin is at 509 billion. Its all-time high, it reached over 1 trillion. Ethereum is 190 billion. The entire crypto market cap is seen right here, 1.08 trillion, which means Bitcoin and Ethereum alone account for more than 60% of the entire crypto market cap. That also means that the rest of the altcoins take up the 40%. And every coin, you can see their market cap size. When I first came into crypto, when I bought Bitcoin for the first time, I think Bitcoin's market cap was 65 billion, somewhere around there, if that, 50 billion. Now it's at 509 billion. In fact, back in those days, the entire crypto market cap was only at 300 billion, or the lowest I saw it, I think, was 220. No, less than 200 billion at one point, the entire crypto market cap. Especially when Bitcoin was 70 billion market cap size, was 50% of the market. All right. So both Bitcoin and Ethereum share similarities. They are assets based on a publicly displayed distributed ledger called a blockchain and could be stored in digital wallets, use alphanumeric strings as addresses, and are traded on cryptocurrency exchanges. Okay, so that's where it's similar. Both Bitcoin and Ethereum are decentralized cryptocurrencies, meaning they are not used or regulated by central banks or other financial authorities. Instead, they rely on computers running copies of their network known as nodes to ensure every network participant is on the same page. There are notably crucial differences between both cryptos. These differences set them apart and have led to various debates in which some argue Bitcoin and Ethereum are competitors. In reality, they may complement each other because they serve different purposes. That is true up until now. They weren't competitors, but they are now, because now Bitcoin is able to do what Ethereum was doing. Yeah, we'll get into that on the next article here. Bitcoin may be used as a store of value, while Ethereum is used to interact with applications built on the Ethereum blockchain. See, up until now, you couldn't build anything on the Bitcoin blockchain, but you can build on the Ethereum blockchain. In a portfolio, Bitcoin may be used to preserve value and as a safe haven, while Ethereum could be used to access decentralized financial services. A safe haven is an asset whose value is expected to be preserved or to rise during market downturns. So, what is Bitcoin? Bitcoin was the first crypto to be launched that functions independently of any central authority. The first block of data on its blockchain, known as the Genesis block, was mined in January 2009 by its pseudonymous creator, Satoshi Nakamoto. Since then, Bitcoin's adoption has been steadily growing over time. Bitcoin was created as a peer-to-peer electronic cash system, which means that transactions can be conducted without any central authority. The concept that led to the creation of the Bitcoin blockchain was created in 2008 through a white paper written by Nakamoto. Bitcoin allows users to manage a currency outside the control of any government, bank, or financial institution. Instead, it relies on a decentralized network of users running the Bitcoin blockchain software with a set of rules every network participant agrees to. The rules determined by the software determine how transactions work, the time transactions take to settle, a 21 million Bitcoin supply limit, and more. Bitcoin was the first crypto. Wait. I got to ask this question again. I won't put anybody on blast, but I'll do it this way. If you have read the Bitcoin white paper, type Bitcoin white paper in the chat box. If you've read it, type Bitcoin white paper. This is key. One thing that in America, we do not teach financial literacy. Like Dr. Nelson said last night, there is no class called Wealth 101. All right. How to walk off your job 102. How to create a trust 103. There is no class that teaches us that. At most, they teach us how to divide, multiply, supply, and what the denominations of coins and money is, but they don't tell you what it actually is. It's like you're a quarterback that doesn't read the playbook. You know, if you're going to be in the financial space, you got to read the first document that created this revolution. If you have not read it, or if you don't like to read, we even made it easier. Go to YouTube, type in Bitcoin white paper, Brandon Ivy. I think that's, let me pull it up. YouTube Bitcoin white paper, Brandon Ivy. Wow, I did that 5 years ago. Really? This only has 650 views? That's crazy. That's crazy. That's only really? Man, people are stuck in the matrix. So, yeah, just type it in. I titled it The Bitcoin White Paper. How let me see. 22 minutes. 22 minutes, that's it. So take 22 minutes. Next time you're on your jog, your walk, you're exercising, whatever, put your headphones on and then just take a listen to it. You're driving in your car. All right. I thought I did it longer than 5 years ago. So read the Bitcoin white paper. So let me go back to this. So Bitcoin Was the first cryptocurrency based on decentralized ledger technology called the blockchain. Now you'll notice if you listen to the news or any outside crypto source, it's rare they call it blockchain. They always use the word, yeah, we're really looking into decentralized ledger technology. Michael, you say 6,000 views? Why did mine only say 500? Oh, maybe that needed. I'll look one more time. Unless somebody else. Bitcoin white paper, Brandon Ivy. Oh, no, that's subscribers. That's 6,672 subscribers. I only got 650 views on this video. That's crazy. And 3 comments. I deleted the other 2, and there's only one. Coco Bouger, that's Bouger. She's the only one that commented on this. That's really crazy. No problem, Michael. Like 6,000. It should have 6,000 views. My influence is more than 6,000 people. It shows you people are still, man, stuck in that matrix. All right. So blockchain technology solved a number of problems, including the Byzantine generals problem, which describes the difficulty decentralized systems have in agreeing on a single truth. To overcome the Byzantine generals problem, Bitcoin employs a proof of work method and a blockchain. The multiple miners, who all have the role as generals, solve the difficulty. Each node makes an effort to validate transactions that are identical to communications sent to generals. Just like on the Vara side, for people that say, what are our access keys? The access keys is doing the same thing. It's validating transactions in the entire Vara ecosystem. When you look at Gala Games, Gala came out with their nodes. What were their nodes doing? Validating all the transactions in the Gala network. The Bitcoin blockchain is publicly available and is associated with the history of every transaction ever conducted on it while being distributed among several nodes to prevent tampering. If a different version of the blockchain is detected, it is rejected by other network participants, known as tampering. This is why it's very hard to try to hack the blockchain or somebody try to change anything. You would have to hack more than 1 million computer systems. It is wildly expensive. It would cost billions of dollars just to be able to change temporarily one block. And that one block is only worth right now 6 Bitcoin. So it's not worth it, only for bragging rights. So who would be willing to spend billions of dollars just to prove a point? There's only one man crazy enough on the planet that I could see trying to do something like that, and that's Elon Musk. But I don't think he's that crazy enough to spend billions just to prove something temporarily that will be fixed almost instantly, just to prove a point. But he did buy Twitter for $40 billion. Who knows? But tampering is detected through long strings of numbers known as hashes, which must be exactly the same for every node. The Bitcoin network processes sets of data and turns them into hashes through the SHA-256 hash function, the algorithm that processes data to turn into those long string of numbers. Once a valid hash is found, it is broadcasted to the network and added to a new block. Miners on the Bitcoin blockchain generate and broadcast these blocks through a POW, which means proof of work process, in which machines use vast amounts of computing power to engage in hashing functions. Through proof of work, network participants reach a consensus. So Bitcoin is proof of work. When people say Bitcoin is made up out of thin air, that is wrong. Bitcoin is proof that something actually took place, that there are humans and machines and energy and money is involved to create a block, and the reward for creating that block is Bitcoin. Just like gold. Gold is proof of work that somebody dug into the ground. Does gold just spring up from the ground and land in your hand? Or do you have to put in some work to get it? Is gold just laying around on the ground somewhere unless somebody put it there? No. You gotta take a lot of work and effort to find it, to dig it, to mine it, to process it. That's why it's so valuable. Same thing with Bitcoin. This is not proof of work. This $100 bill is not proof of work. This is the government turning on the printing press and printing more of it because they want to. So anyways, know what proof of work is. Bitcoin's mining and consensus processes ensure that malicious actors cannot alter other users' balances or spend their funds twice while keeping the network up and running with almost no downtime. Being a tamper-proof crypto that can be transacted at any time without any intermediaries or central banks, controlling it has helped Bitcoin's popularity surge over time. While Bitcoin started as a medium of exchange, meaning it can facilitate the purchase of goods and services, it was also adopted as a store of value. A store of value is an asset whose value is maintained over time. Okay, you guys get that? You understand what Bitcoin is? All right, now what is Ethereum? While Bitcoin uses blockchain technology, and you'd be surprised how many people's in crypto and they still don't understand what Ethereum is. And that's okay. I know people that have made millions of dollars on Ethereum and they can't tell you what Ethereum is. So while Bitcoin uses blockchain technology for monetary transactions and allows nodes and messages to be attached to each transaction, Ethereum takes it a step further by using the blockchain to create a decentralized computer. Ethereum is a decentralized, open source, and distributed blockchain network powered by its native cryptocurrency, Ether. So far, that's the same as Bitcoin. Used to make transactions and interact with its applications built on top of the Ethereum network. Ethereum's white paper. Oh, that's another question. I did not read or record myself reading the Ethereum white paper, but if you've read the Ethereum white paper, type Ethereum white paper in the chat box. I'm going to catch a lot of you here. Maybe I do need to record myself reading that. Why did I not do that back in the day? I know at some point I had a project where I was going to record myself reading every white paper. And I started, and then I got distracted with probably some other projects and never got back around to doing it. But let me see what I've done. I know people have asked for me to read different white papers. Let me just put in white paper. I have 9. I've read 9. Oh, I did. I read the Ripple. I recorded myself reading the Ripple white paper, The Future of CBDCs. Okay. IMC token white paper, Facebook Libra white paper, the Bitcoin white paper. I thought it said I had 9. Why is this only showing 4? Let me do that again. White paper. It says 9 there, but it's only 4. Oh, unless I deleted some or unlisted. U.S. Federal Reserve. Oh, this is the one. Marnita wants me to be doing this one again. The U.S. Federal Reserve CBDC White Paper Part 3. The U.S. Dollar Digital White Paper Part 2. Which one was the Digital Dollar Project White Paper? Digital Dollar Project White Paper Part 2. Oh, yeah, I forgot about those. back in 2022, early 2023. Okay, I might, I'll put it down here. Record ETH white paper. I do remember being frustrated reading that white paper. It is not simple, and it is chock full of nerd language that I didn't even understand. It was frustrating. Let's see here. Ethereum white paper in PDF. This was not an easy read on this page, but it wasn't an easy read for me back then. So now I know a lot more about crypto now than I did back then. There's a lot of UTXOs mentioned in here. Alternative blockchain applications. Yeah, this is not the actual white paper, is it? I remember this. Yeah. Next generation smart contract. Yes, it is. I might record myself reading this if I get some time. But not many of you typed Ethereum white paper, so nobody's read the Ethereum white paper. Or you need some understanding in it, what you're reading. Uncommon concern about Ethereum's issue of scalability. But I also like see their direct PDF. That looks like a broken down one. Ethereum white paper PDF. Oh, they got it. Ethereum white paper made simple. Okay. PDF version of Vitalik's white paper. I'm not downloading anything from here. Could be malware. I'll go straight to their website. All right. That's another project for me later on. Okay. So Ethereum. Yeah. Someone said, nope. Facebook just said, nope. Did not read it. Marty is saying, I need to read the CBDC white paper again. I might just have to post up that recording because that's going to be important too. We covered that yesterday. The government politicians are trying to write a law banning CBDCs in the United States. All right, Ethereum is a decentralized open source and distributed blockchain network powered by its native crypto Ether, used to make transactions and interact with applications built on top of the Ethereum network. Ethereum's white paper was published in 2013 by its co-founder, Vitalik Buterin, detailing the use of smart contracts, which are self-executing agreements written in code. What link are they giving here? Oh, just on what is a smart contract? Smart contracts allow for the creation of decentralized applications, or dApps, which are applications that work without a central entity behind them. In 2014, Buterin and Ethereum's other co-founders sold Ether to raise funds for Ethereum's development. Ethereum's co-founders include Buterin, Gavin Wood, Jeffrey Wilkie, Charles Hoskinson, Mihai Alisi, Anthony Delorio, and Amir Chetrit. The co-founders also set up the Ethereum Foundation in Switzerland, a nonprofit organization dedicated to supporting the Ethereum network. In July, in the crypto space with the goal of decentralizing everything on the internet. Similar to Bitcoin, Ethereum is a decentralized platform without a governing central authority that uses proof of work to ensure malicious actors aren't able to tamper with the blockchain data. Ethereum has its own programming language called Solidity, which is used to program smart contracts to run on the blockchain. The potential applications of Ethereum are wide-ranging thanks to the use of smart contracts. Its main use cases may not have yet been invented, similar to the way Facebook and Google weren't created years after the internet was launched. Innovative on the Ethereum network is surging, with decentralized applications offering financial services, non-fungible tokens, NFTs, being examples of what smart contracts allow developers to create, while Bitcoin is used as a medium of exchange and store of value. Ether is used to interact with applications on the Ethereum network. Paying for transactions, creating smart contracts, and using dApps all require users to pay fees in Ether. As the value of Ether went up, it also started being used as a store of value. Decentralized applications built on Ethereum allow Ether and other crypto assets to be used in a plethora of different ways, including as collateral for loans or be lent out to borrowers who earn interest. Collateral refers to assets pledged as security for repayment of a loan. For example, a user can deposit $1,000 worth of Ethereum in a decentralized application to take out a $750 loan through it, while earning interest on the deposited funds. In other words, you're able to borrow from yourself. Remember last night on the WGC, I talked about a platform that was called Makara. Was it Makara that let me do that? No, Makara let me have a basket of different sweets on my portfolio. That was a different one. I think that went under as well. Yeah, I took that app off. But you're able to, if you guys remember, maybe 2-3 years ago, something that was called yield farming was the biggest thing. It was the craze. People were getting rich overnight off of that. But it would act. Yeah, thank you, Marty. The Nexo. It was Nexo that allowed me to. Here's the genius of it. Let's say I put $1,000 of my own Ethereum in the Nexo account. I can borrow $500 of my own money, use it to go invest on another project, flip it, pay myself back, plus the interest back goes back into my account, and I just made money on my own money. While I'm still earning interest because my Nexo account is also being used for others to borrow from, and I'm earning interest because I'm pledging to keep that amount of money on that account. It's a genius program to use, and Nexo wasn't the only one doing it. And the same thing is also going to end up happening on the Bitcoin network. You're going to start seeing that pop up in the next year. Key differences between Bitcoin and Ethereum. While both the Bitcoin and Ethereum networks are based on the concept of distributed ledgers and encryption, they are vastly different in terms of technical specifications. For instance, while Bitcoin serves as a digital equivalent of gold used to store value, Ether is used to power the Ethereum network and its applications. It is possible to issue new tokens on both the Bitcoin and Ethereum networks. Bitcoin uses the Omni layer, a platform meant for creating and trading currencies on the Bitcoin blockchain. The Omni layer's adoption has centered around stablecoins. Ethereum tokens, on the other hand, are issued following different standards, with the most popular one being ERC20. The ERC20 standard defines a list of rules for the tokens on the network. The ERC20 standard includes several functions developers have to implement before launching their tokens. These functions include providing information about the token's total supply, providing account balances on users' addresses, and allowing funds to be moved between addresses. Bitcoin transactions are monetary in nature, but transactions can have notes and messages affixed to them by encoding these notes or messages into data fields in the transactions. Ethereum transactions can contain executable code to create smart contracts or interact with self-executing contracts and applications built using them. Other differences between these networks include the time for new blocks of data to be added. which determines the time it takes to confirm transactions. Blocks on the Bitcoin network are added on an average every 10 minutes, while on Ethereum, they take about 15 seconds. Public wallet addresses are also different on both networks. These wallet addresses are unique identifiers that allow users to receive funds comparable to an international bank account number. That's where the IBAN comes from, which is a unique identifier financial institutions use to identify which bank and country a client's account belongs to. On Bitcoin, addresses can start with a 1 or a 3 or with BC1, while on Ethereum, these start with OX. Another thing, I haven't taught this in a long time, is be familiar with if you have these tokens, they all have unique wallet addresses. Kind of be familiar with those addresses. They're all unique. Like Tron, you always see, is it a T that starts before everything, or there's a T in there? But every BNBs, they're all unique. So that when you see a string of addresses, you automatically identify what blockchain they belong to, what tokens they belong to. So anytime I see an OX address, I know, okay, that's Ethereum. Anytime I see, and now most of the Bitcoin addresses now have moved from 1 or 3. They're now all mostly starting with a BC1 or something like that. But a 1, 3, or BC, I know that's Bitcoin. So creators: Bitcoin, Satoshi Nakamoto. Ethereum, Vitalik. Launch date of Bitcoin, January 2009. Launch date of Ethereum, July 2015. Man, that was only 1 year before I got into crypto. And I remember 2016, Ethereum even forked with Ethereum Classic. A lot of people I know made millions of dollars in 2016 because of Ethereum. And there were a lot of network marketing companies that popped up during that time that were claiming to be either mining this or trading this. They made a freaking fortune. Kathy Keene, Calais Taylor, those people back in those days, they were killing it. That was before that's actually what got my attention. I started seeing people in the industry that were making millions. And I was like, what the hell are you guys doing? Currency versus platform. Bitcoin, a credible alternative to traditional fiat currencies. Ethereum, a platform to run programmatic contracts and applications via Ether. Consensus algorithm. Proof of work. For Bitcoin, Ethereum used to be proof of work, and then they moved to proof of stake. Block time for Bitcoin, 10 minutes on average. That's why it was always slow, why it wasn't used as a day-to-day transaction, more of a store of value. Ethereum, 15 seconds. Transaction throughput. Bitcoin, 7 transactions per second. Ethereum, 30 transactions per second. Supply. Bitcoin is finite, capped at 21 million, whereas Ethereum is an infinite supply. While both Bitcoin and Ethereum have relied on proof of work consensus, Ethereum is moving away from it and into a proof of stake consensus algorithm. Proof of stake operates depending on a transaction validator's stake in the network. To become validators on Ethereum, which are entities that verify transactions to ensure the network isn't being tampered with, users have to stake their Ether, but you just can't stake half the Ether. I think it's 32 or 33 Ethereum to be able to become a validator on the Ethereum network. Proof of stake consensus algorithms limit the energy necessary to reach consensus by attributing mining power to the proportion of validators' tokens instead of having miners with specialized computers. A proof of stake network is more energy efficient, with lower entry barriers for validators and stronger immunity to decentralization because it is easier to become a validator. Easier? How many people running around with about 40K, 50K? Bitcoin is also represented on the Ethereum blockchain in the form of ERC20 tokens. To take advantage of dApps, a tokenized version of Bitcoin was created and launched on Ethereum. We call that, the wrapped Bitcoin. There are numerous tokenized versions of Bitcoin on the Ethereum network. These are backed by Bitcoin at a 1-to-1 ratio. meaning that for every ERC20 token representing Bitcoin in circulation, there is one Bitcoin in custody backing it. Tokenized versions of Bitcoin on Ethereum allow users to keep holding Bitcoin while using decentralized applications. For example, token holders can lend their Bitcoin to earn interest. Bitcoin versus Ethereum scaling solutions, okay? The base Bitcoin and Ethereum networks both suffer from scalability issues. While Bitcoin handles on average 7 transactions per second, the Ethereum network is able to handle 30 transactions per second. In comparison, Visa handles around 1,700 transactions per second, while claiming to be able to scale to 24,000. With the number of, and so if you want to see mass adoption of crypto in day-to-day lives of transactions, we need to increase these transaction speeds to be closer to what Visa and MasterCard can do. With the number of people using both blockchains grows over time, both Bitcoin and Ethereum have almost reached their capacity limitations and are in need of solutions. Go figure. What do you think the Lightning Network? Dark fusion technology. The whole concept of batch. So before I get into that, you need to understand what the problem is that these things are solving. Okay, so you understand why is there a need for that? Well, because Bitcoin is only 30 transactions per second, and Ethereum's 30, and Bitcoin's only 7. That's a problem. Scalability problem. Bitcoin and Ethereum have different approaches to solving their scalability issues. Bitcoin has implemented technical improvements such as SegWit, segregated witness, an upgrade that segregates some data outside of the space available in each block propagated to the network. SegWit allows for a more efficient use of the limited 1 megabyte of space each Bitcoin block has. Moreover, developers have been working on a layer 2. What was that? A layer 2 scaling solution, referring to a solution that would build a transaction layer on top of the base blockchain called the Lightning Network. On the Lightning Network, transactions are fast and fees minuscule, as they are sent through payment channels that users create. The Lightning Network's user-generated payment channels are pre-funded with Bitcoin and could allow most of the transactions to move from the base blockchain and into this layer 2 network. So you guys, I'm giving you guys the base foundation between why projects like Dark Fusion are so big, what they mean to the network. Proponents expect the Lightning Network to be able to handle up to what? 15 million transactions per second. So let's go back. Visa handles 1,700 transactions per second, but they're able to scale to 24,000. This Lightning Network technology using crypto is going to be able to handle up to 15 million transactions per second. Do you guys understand this? I'm reading this slowly for a reason. I want this to sink in. These would not be settled on the Bitcoin network itself, as the only transactions that will be settled on the base Bitcoin blockchain would be those opening and closing Lightning Network payment channels. In other words, all of those transactions are being batched together and then sent to the Bitcoin network separately. But the transaction has already been taken and verified. So we don't have to wait for the blockchain to verify it, which could take some time, especially if the network is congested. Ethereum is also implementing scaling solutions that will both work on the base Ethereum network and through layer 2 networks. Ethereum's main bet to expand its blockchain is called sharding, and would reduce network congestion and increase transactions per second by creating new blockchains called shards. Every device running the Ethereum blockchain would see the random access memory and storage requirements drop significantly, as shard chains could help spread the computing resources needed to run Ethereum. So if you want to picture this, picture the blockchain. Okay, I'm going to do this with Bitcoin and Ethereum. So you got Bitcoin's blockchain block. Every 10 minutes, a new block is added. That's not going to change. Then they got this Lightning network that is running next to it. Think of it, you've got the slow lane on a freeway and the fast lane, only the fast lane is a million times much faster. So Bitcoin is the slow lane. And then you've got the Lightning network is the fast lane, and they're parallel to each other. And I don't know how big of a size these blocks are going to be. Batches, not blocks, the batches are going to be in the fast lane. But once that fills up, it gets kicked to the slow lane onto the Bitcoin network. And then the next one that fills up in the fast lane, as batches, they get kicked to the slow lane. But the fast lane never stops. On the Ethereum network, you've got the Ethereum blockchain going like this. But right next to it is a separate lane they call sharding. Okay, so it's not how the Bitcoin Lightning network is working with batches. The sharding is, since Ethereum is already faster than Bitcoin anyway, it's like leftovers of the Ethereum network that is saying, okay, it's gonna help support the Ethereum slow lane by sharding off a little bit. The excess, we're not gonna allow that to slow us down. We're gonna kick that energy off, but keep track of it so that this thing can keep running smooth and keep running fast. Am I doing a poor job trying to visualize this for you guys? But I see it in my head. And I'm doing this. I'm trying to see how can I break this down in a way that my mom can understand. And I know my mom might have to draw it out on paper to get that. So Ethereum, they call it sharding. You get it, Marnita? Did that make sense? I wanted to see if it made sense in my head and trying to get it out to you guys. All right, every device running the Ethereum blockchain will see the random access memory and storage requirements drop, as shard chains could help spread the computing resources needed to run Ethereum across a total of 64 networks. In other words, it's like adding a turbo booster onto your engine. So Bitcoin is not doing it that way, but Ethereum is like we're adding an extra boost, like Fast and the Furious. And you see them right to get to the end, right, close to the finish line. They press that booster button, and the nitro hits into the engine, and it takes off more. That's kind of what sharding is here, is adding an extra component, turbos, onto the existing lanes. Layer 2 scaling on Ethereum rely on servers that group large amounts of transactions before submitting them directly to the Ethereum blockchain. The way these transactions are grouped and then broadcast to Ethereum varies significantly between implementations. Other layer 2 solutions for Ethereum are called side chains. Side chains are independent networks that run parallel to the Ethereum network and are compatible with the network via protocols that allow users to swap tokens from one another from one network to the other, effectively allowing them to use applications built on Ethereum while paying less in fees. So these are all the other tokens built using the Ethereum blockchain that until now was not possible on Bitcoin. One thing I said last night in the WGC training was if you go to CoinGecko, click on categories, and if you're trying to build your crypto portfolio, you can see there's different portfolios to have. But notice you have layer 1, but you want to also look at layer 2. Layer 2 coins. These are all tokens that's built on somebody else's blockchain. And let's see, I want to use an example. Do I use Matic as an example? Mantle. So here's how you can tell. When I clicked on mantle, for example, right? You see its symbol, but over here on the contract address, you see Ethereum symbol, which means it's built on the Ethereum blockchain. Now you can do this with every token out there. Matic is built on the Ethereum blockchain. They should have another tab over here that actually shows that too. Loopring, the Ethereum blockchain. XDAI. Huh. It doesn't show. Oh, they have a different Gnosis chain ecosystem. I am not familiar with that at all. But this is not the Ethereum blockchain. They're on something called a Gnosis chain. Okay. So anyways, I'm showing you guys where to go to see this kind of stuff. All right. Here. Okay. So that's Bitcoin and Ethereum take advantage of multiple scaling solutions to help reduce network congestion and increase the number of transactions they can handle per second. All right. So you guys now should have a clear understanding between the difference between Bitcoin and Ethereum. But now, what is the Bitcoin Lightning Network and how does it work? The Lightning Network is a layer 2 solution, but this time it's on the Bitcoin blockchain. Layer 2 solutions are a key component for scalability in blockchain. So one says, so I don't understand, what's the purpose of a layer 2? It helps to scale whatever blockchain it's on. Of all layer 2 solutions, Lightning Network is a crucial one owing to its association with Bitcoin and its ability to help add utility value to the chain. Bitcoin was envisioned and created as a peer-to-peer electronic cash system. This meant that users could transfer value without an intermediary. At the time of its inception, the creators of Bitcoin, I just had another aha moment. I'm still stuck on that white paper thing. I know what I was doing back in the day, and I never completed it. I was going to read about 15 of the main crypto white papers and put it in a video course for a lesson as a lesson. Huh. Let me make note of that. The lesson is just crypto white papers. So everyone will have a one place to go. All right. Create lesson. Reading 15. So I'm going to have to select 15 white papers to read. And they've got to be 15 that I believe are going to survive the next crypto storm. Okay, I'll have that down there. I just had an aha moment on that. All right, so Bitcoin was envisioned and created as a peer-to-peer electronic cash system. This meant that users could transfer value without an intermediary. At the time of its inception, the creators of Bitcoin concentrated on these two aspects mainly, without focusing on scalability and transaction throughputs. While at the initial stages, this wasn't too much of a hassle. As years unfolded, this proved to be a conundrum. It was commonly known to be the blockchain trilemma, where blockchain architects had to find the right balance across decentralization, scalability, and security. Bitcoin has grown into the most decentralized blockchain and is considered quite secure. However, scalability has been a concern for Bitcoin-based transactions. Transactions take anywhere between 2 minutes to several hours to complete on the Bitcoin network. This issue has been more pronounced as new blockchains such as Ethereum and Solana with better transaction throughput have emerged. Ethereum's transactions per second of 30 is higher than that of Bitcoin's 5 per second. Solana takes the comparison to new levels with up to 65,000 transactions per second, which is why I said last night Solana is one of those tokens you want to have in your portfolio. The rise of scalable blockchains has left chains like Bitcoin and Ethereum with no other choice but to rely on layer 2 solutions. Better transaction throughputs are also fundamental for chains that aspire to have a healthy application ecosystem. User experience on decentralized finance applications can be quickly soured by frictions like low transaction speed and high transaction costs. That's the problem. So if that's the problem, whoever has a solution to that problem is going to win. As far as Bitcoin is concerned, the most important layer 2 chain is the Lightning Network, which provides 4 important features. So what is the story behind the evolution of the Lightning Network? It is essential to appreciate the origins and how the Lightning Network has evolved to what it is today. In February 2015, Joseph Poon and Taj Drija got together to solve one of the most pressing issues and vocal points of the Bitcoin ecosystem: the increase in transaction fees. That was the most pressing issue. Taking a cue from Satoshi Nakamoto's writings on payment channels, the Maverick duo started working on decreasing the transaction fees. In January 2016, a detailed white paper was published, and work on the Lightning Network gained traction, with more developers starting to collaborate with the duo. Within a couple of years after the white paper and developer collaboration, Lightning Labs, the company that maintains the Lightning Network, released a beta version for developers to test. This started attracting heavyweights in the tech industry to take notice of the plans of Lightning Labs and the value the layer 2 solution can add to the greater ecosystem. One of the big names that supported Lightning Labs was the then CEO of Twitter, Jack Dorsey, with plans to integrate the Lightning Network with Twitter. Finally, 2020, the year of the COVID-19 pandemic, was a milestone year for the Lightning Labs team, which saw marquee releases with features such as Key Send and Wumbo channel. Wumbo has a key release that increased the transaction size that can be performed over the Lightning Network. Currently, the Lightning ecosystem boasts an array of products, projects, solutions, and experiments across verticals and functionality that includes gaming, wallets and payments, node management, infrastructure, and rewards. Wow, what does that sound like? A few noteworthy features and products built over the Lightning Network are as follows. Loop allows users to make a Lightning transaction to an on-chain Bitcoin address or send on-chain Bitcoin directly into a Lightning channel. Pool helps manage the liquidity needs of the Lightning Network user. Taro helps issue or mint assets on the Lightning Network. Faraday, well, that's like the Faraday cage. Faraday is a data analytics tool that helps node operators optimize channels and the flow of funds. With new projects being developed, Dark Fusion, and several big names backing Bitcoin and Lightning Network, Coinbase and BlackRock, this ecosystem is turning into one of the most thriving ones in the crypto world. Let me say that one more time. This is for the people in the back. This ecosystem is turning into one of the most thriving in the crypto world. So when I talk about the river of money, and I know it's flowing in the direction of blockchain, and then within blockchain, where is it flowing there? You got to get a little bit more specific. Well, metaverse technology, smart contract technology, NFTs, DeFi. Okay, so I know it's flowing there. So who's doing that? Well, it used to be the big dog was Ethereum, but they got problems. They got scalability problems and they got fee problems. And they got the SEC and they got regulator problems, considering them all securities. But which one is not a security? Oh, Bitcoin. Oh, Bitcoin is also having a layer 2. Oh, they've solved the problem with Lightning Network. So what projects are now using Lightning Network? So then you start looking. Who's doing Lightning Network? Coinbase is now adding it. Binance. BlackRock just partnered with Coinbase. $10 trillion on their name because they need to have a solution that they can do with all of their investors on a fast network that's secure and that's protected, and that's Bitcoin. That's why Coinbase is adding Lightning Network. Huh. Oh, wait a minute. There's something new called Dark Fusion that is utilizing Bitcoin Lightning Network, that's doing transactions and gaming and minting NFTs on the Bitcoin network? Huh. 1 million transactions per second? Low to no cost fees? I'm thinking like a CEO. Follow the breadcrumbs. All right. As briefly stated above, the Lightning Network leverages the concept of payment channels as stated by the legendary Satoshi Nakamoto. The protocol enables the creation of a peer-to-peer payment channel between two parties. Once established, the channel allows the transacting parties to send an unlimited amount. You see that? If Bitcoin only has 1 megabyte of memory that it could hold in a block, it takes 10 minutes for every block, 7 transactions per second. But now we bring in something that can handle unlimited amount of transactions that are nearly instant and inexpensive. You just solved the biggest problem in crypto. What was the biggest problem of Blockbuster Video that Netflix solved? See, the whole model of Blockbuster, get off of work on a Friday, go down to your neighborhood Blockbuster, walk up and down the aisle, hope that they got your video that you want. It's not out of stock. And if you were smart, you probably called ahead of time to have it saved for you. You know, if you were a special member of Blockbuster family, go home, watch the video, and then drop it in the drop off. But if you were late, you had to work overtime, you got to Blockbuster, the video was gone, you had to wait till somebody returned it back. You had to return it back by Monday so that they could restock the shelves. And if you're in a city of 30, 40, 50,000 people, and that's considered a small city, and you only got maybe 150 copies of one movie on your shelf, hey, somebody ain't watching the movie that night. So what did Netflix do? Said, how about we will just mail it to you? Well, at least you can guarantee you're going to get the video you want. But that was another problem. It took 3 days for your video to get there. But then all of a sudden the technology got better. And Netflix said, we don't need to mail it to you. We will stream it to you. But at the time, that idea was foreign because, I mean, we still had AOL dial-up internet. How the hell are we going to be able to stream? I mean, it takes 30 seconds for a website to load up. Remember the load up screen? Remember the sound of AOL? You know the internet is connecting. Your computer's connecting to the internet. That was exciting back then. I remember being a kid excited to hear, uh-oh, the internet's connecting. Here we go. But now Netflix solved the problem. They have better technology. We now can stream your movie to you. And now that's all the new streaming services came. You don't need a cable box anymore. All you need is an internet connection. Huh. So now with Bitcoin, we've solved the problem, the biggest problem. As briefly stated above, The Lightning Network leverages the concept of payment channels as stated by the legendary Satoshi Nakamoto. The protocol enables the creation of a peer-to-peer payment channel between two parties. Once established, the channel allows the transacting parties to send an unlimited amount of transactions that are nearly instant and inexpensive. It acts as its own little ledger for users to pay for even smaller goods and services, such as coffee, without affecting the Bitcoin network. To create a payment channel, the payer must lock a certain amount of Bitcoin onto the network. Once the Bitcoin is locked in, the recipient can invoice amounts of it as they see fit. If the customer wants to keep the channel open, they can choose to add Bitcoin consistently. By using a Lightning Network channel, both parties can transact with each other. Why did BlackRock just buy $380 million worth of Bitcoin? They're creating their own liquidity for their ETFs for their network. It's the same concept here. By using a Lightning Network channel, both parties can transact with each other. When contrasted to ordinary transactions on the Bitcoin blockchain, some transactions are handled differently. For instance, when two parties open and close a channel, they are only updated on the main blockchain. The two parties can transfer funds to each other indefinitely without informing the main blockchain, as all transactions on the Layer 2 protocol do not need to be approved by all nodes. It substantially speeds up transactions. The Lightning Network nodes capable of routing transactions are formed by combining individual payment channels between the concerned parties. Therefore, the Lightning Network is the outcome of many payment channels being linked together. Eventually, when two parties decide to finish transacting, they can close the channel, and all of the channel's transactions are then consolidated into one transaction, which is then sent to the Bitcoin mainnet to be recorded. Consolidation ensures, that's another way of using the word batching, they're consolidating. Consolidation ensures that many small transactions do not clog the network at once. Aggregating them into one transaction. Here's how I'll explain this to my mom. My mom is part of a book club and Bible club, and they're always having lunches and brunches and meetings and outings, dinners and stuff. Now, if you have a table of 12 people at a restaurant, two things is going to happen. One person can decide that they pay for everything. For example, when I go out most of the time with my business people, I pay for dinner for everybody. Yeah, Brand is being good to everybody, but I'm also using that as a tax write-off. Give me the $400, $500 bill. I need more of those. So I'll pay for everybody's dinner so I can get the tax write-off. But a lot of times people say, you tell the waitress, oh, we all have separate bills. And then the waitress has got to sit there and break it up to every single one, right? That always takes time. And the waitress is much happier if you just say, oh, it's all going to be on just one bill. So all the transactions still take place, but it's being paid, or people will do this. All right, this is what we used to do back in the day. Everybody, before we had credit cards and whatnot, we all had cash. All right, everybody, you know how much your bill is. Pass the cash up. And there was one person that collected all the money, and then you paid the bill with all that money. But everybody, you paid your part. You collected it. That's what's happening here. The Lightning Network is taking all the individual transactions, collecting it all together, and then sending that to the blockchain to be recorded as one transaction. Is this making sense? If I'm making sense, type yes in the chat box, because you got to be able to visualize this as well. So aggregating them into one transaction takes less time and effort for nodes to validate. Without payment channels, smaller transactions get in the way of bigger ones. congesting the network and increasing the validation workload of the nodes. For example, if Mike okay, they're going to give an example here. Okay, let's see if I was off. If Mike goes to a local coffee shop every day and wants to pay in Bitcoin, he could choose to make a small transaction for each coffee cup. But due to Bitcoin scalability issues, the transaction can take over an hour to validate. Mike will also have to pay the Bitcoin network's high fees, even though he's making a tiny transaction. Small transactions work with traditional payment methods like a card because companies such as Visa have the infrastructure to process more than 24,000 transactions per second. In contrast, Bitcoin on a regular day can validate 7 transactions per second. So with the Lightning Network transactions between Mike and a local coffee shop, Mike 0.02 Bitcoin, channel capacity 0.02 Bitcoin. So Mike's just getting his bagel and coffee. Channel capacity 0.01 Bitcoin, 0.02. I don't understand this chart here. Lightning Network transactions between Mike and a local coffee shop. Okay. Oh, I guess they're showing the fees and the capacity is faster. With the Lightning Network, Mike can open up a payment channel with the coffee shop. Each coffee purchase is recorded within that channel, not on the blockchain, but within that channel. And the shop still gets paid. The transaction is cheap or possibly even free, as well as instant. When Mike's Bitcoin deposit in the channel runs out, he can choose to either close the channel or top it up. When a channel is closed, all of its transactions will then be recorded to the main Bitcoin blockchain. The Lightning Network creates a smart contract between two parties. The agreement rules are coded into the contract upon creation and cannot be broken. The smart contract's code also ensures that contract fulfillment is automatic, as contracts are initially made with preset requirements that all participating parties agree with. Once those requirements are met, and when a customer pays the correct amount for a coffee, the contract is automatically fulfilled without third-party involvement. The Lightning Network anonymizes transactions within a payment channel once validated. All anyone can see is a total transfer of value, not the individual transactions within it. It is entirely possible to conduct transactions without any restrictions outside of the blockchain. Off-chain transactions can be trusted to enforce the blockchain, considering they end up on the mainnet once payment channels are closed. The mainnet is the arbiter of all transactions. While off-chain protocols have their own ledger, that ledger always integrates back onto the main chain, which is core to the Lightning Network's design. Tangible advantage. I hope that makes sense to you guys. It's even a little bit clearer in my head too. That's why I do this. I'm always learning too. It's helping me to be able to explain it. I know how it works, but even seeing it and doing it this way, I'm getting a clearer picture in my head on how can I explain this. Have you guys ever learned something, but it's hard to be able to explain it to somebody else, but you do understand it? On its official website, the Lightning Network explains it as leading technological development in multi-party financial computations with Bitcoin. The Lightning Network provides the following advantages over the native Bitcoin blockchain: scalability, speed, micropayment support, and low energy requirements. That's what it's saying. That's its solution there. The lack of scalability has been one of the most talked about features as far as the Bitcoin blockchain was concerned. The addition of each block for every transaction severely hampered the scale of the network. The Lightning Network solved this by taking the transactions off the blockchain, bearing in mind security and anonymity considerations. Furthermore, as transactions are taken off the main blockchain and carried on in layer 2 blocks, they are much faster and more efficient. I have a prediction to make. I said this 5 or 6 years ago. I said the current blockchain as you see it today is going to be blockbuster video. That the future blockchain that we're going to see that the world will be using and utilizing is light speed ahead of what we're using right now. I believe there's going to be a layer 3 network coming maybe in the next 5 to 10 years. That they'll still have the main Bitcoin blockchain, but there's going to be a layer 3 that's even triple the speed of layer 2. But we'll see. So the Lightning Network also facilitates swift micropayments. And I believe that this layer 3 is going to be the one that is able to combine every blockchain out there, transactions, interoperability, and then we'll be able to, because of its smart contract, break it up so that they can be recorded on the individual blockchains that they're supposed to go. So that the people doing transactions, they don't even know. It doesn't matter what blockchain is being happening. It's the transactions taking place. Everything else happens behind the scenes, like underneath the hood. That's just my opinion. We'll see how that plays out. I'm not smart enough on the programming side to understand all that stuff yet. So fast micropayments. Wait. The Lightning Network also facilitates swift micropayments. Bitcoin imposes a minimum transaction output that is more than 100 times higher than the Lightning Network. Fast micropayments are the future of Web3 applications, like gaming. Let me say that one more time. Fast micropayments are the future of Web3 applications. So how are we going to move gaming from Web 2.0 to Web 3? You need to have fast micropayments. So applications like gaming and achieving this use case is extremely important for the usability of the chain. Fast micropayments are made possible by the Lightning Network. However, they are only viable if these micropayments can be performed at very low transaction fees. A lack of efficient transaction processing often ends to the blockchain losing market share to its competitors. So in other words, they're putting the challenge out there. We gave you guys Lightning Network, but now you have to program something that can handle these transactions at a low cost. Enter dark fusion technology. They're not going to be the only ones attempting this, but right now they're the first. The DeFi ecosystem on Ethereum had noticeable friction in 2021 when gas fees increased due to the explosive growth of the chain. As a result, the Ethereum ecosystem had to rely on layer 2 solutions like Polygon and Immutable X to achieve transaction efficiencies. This was also the time when competitors like Solana and Avalanche gained momentum and market share. Last but not least, considering the transactions are taken off the chain, the Lightning Network reduces the energy required to operate nodes. This has significant implications for a sustainability perspective, as the energy requirement to support those transactions is lower than if they had been performed on the Bitcoin network. So that now solves another problem. A lot of Bitcoin critics say it takes too much energy, the environment. Oh, really? Well, now we have the technology that brings that energy cost way down. Bitcoin has been receiving criticism. Oh, there you go. Bitcoin has been receiving criticism from environmental and social and governance investors who look for good energy credentials with their investments. By reducing the energy footprint and taking the bulk of the transactions off the Bitcoin blockchain, the Lightning Network helps Bitcoin's credentials from an ESG perspective too. Now, when you connect the dots, Larry Fink, BlackRock, Fidelity, BNY Mellon, Coinbase, Bitcoin Lightning Network, Layer 2, Dark Fusion, gaming, fast transaction speeds, lower costs. Things start to make sense. I'm a patterns guy. I had to be this way. I got a learning disability, y'all. It's auditory processing disorder. It takes me a while to, when I'm told and hear something, I'm very good at hiding it. Very good. I learned at an early age, but I wasn't diagnosed until I was an adult. So I figured out how to hide it. You don't know. Most of the time, I don't get it, but you don't know I don't get it. Later on, I do a lot of background study from what I remember so that I can get it. So next time we talk, I do know what we're talking about. So I learn with pictures and patterns and connecting the dots. So I'm connecting all these dots and it's creating a picture for me that lets me know I'm on the right path, the river of money. Potential drawbacks and risks. Okay, so what are the risks of the Lightning Network? And this, I want to know this because then I want to see, is anybody out there solving this? Despite adding a key dimension to enhance Bitcoin network capabilities across the blockchain trilemma, the Lightning Network is not without its downsides. The key issues are the following: cost and friction in getting onto the Lightning Network, dark fusion; counterparty risk during transactions, dark fusion; a lack of functional scalability. Well, hell, multi-layer based Bitcoin based smart contracts, scalable dev tools and products for the Lightning Network. So they are creating solutions for what I'm already reading to you right now. So you're hearing what the Lightning Network does. So this is the program that is building on top of that. The first significant breakthrough in DApp and the token development on the Bitcoin network. Dark Fusion is a product suite consisting of smart contract modeling language that we call simple contract modeling language, designed to function on the Bitcoin protocol via the Lightning Network. Using SCL, we have developed the SCL token standard. It enables developers to quickly deploy tokens on the Bitcoin network, a wallet to manage these tokens, a decentralized exchange enabling users to trade these tokens, and an explorer to easily view and track transactions. All of this on the Bitcoin Protocol. That's why I came out of retirement, not because of a game. Why? Well, one says, while the Lightning Network brings transaction fee efficiencies once payment channels are created between the sender and receiver, the process of setting up the channel is cumbersome. So why don't you use technology that will do it for you? See, I'm asking this question as if you are a business owner. Why reinvent the wheel? The process, users will need to move funds onto the Lightning Network and lock them into a channel. The process of moving the funds onto the Lightning Network is expensive. Huh. So, through the development of SCL, we are creating a string of firsts: proprietary wallet to transact, decentralized exchange running, and a block explorer to view and track. Full Lightning Network enabled BTC wallet, low cost transactions, integrated decentralized exchange. So we have no escrow, instant transaction, but look at the fees. 0.0002 cents. So this project has created solutions. Oh, this is new. I haven't looked at this. They updated this. Huh. This is all new. Wow. Simple tokens. SCL facilitates the minting of easily transferable tokens on any UTXO-based blockchain. Token validity can be independently verified. Staking, real NFTs, batching. No need to learn a new language. Build with familiar coding languages that suit you. Dev tools. This is nerd language I don't even understand. Blockchain as a service. This is the stuff I'm looking for. These type of companies that you want to invest in, that is taking advantage of what this is providing. Lightning Network. Once the funds are locked into the channel and transactions between two parties begin, funds are still at risk. Funds can either get stuck on the channel due to technical issues, or the counterparty may choose to close the channel if the user goes offline and takes the funds. These offline risks are being mitigated by watchtowers and Lightning service providers, but that adds a vector of centralization to the network. So far, there has been no foolproof solution to the counterparty risk that a user is exposed to until now. They don't know about dark fusion yet. The Lightning Network also has a more functional limitation. Due to the very nature of the payment channels being used just between two parties, it is not seamless. As a result, a business that wants to pay or transact with multiple counterparties will need to open channels for each one of them and manage them individually. Until now. That's why I'm loving this. Oh, I didn't know that. Oh, this has not been publicly made. They haven't made a public announcement about this yet. Oh, all right, Marnita, this is what I was talking about. They snuck this up out there. They didn't make this public. The other day, Saturday, I read the tokenomics of Vara. I have this, but I wasn't allowed to share it yet. But now that they've got it on the website, I wonder if they were doing that secretly and didn't want anybody to know yet. But they got it on there. It's public. Therefore, guess what I'm going to do? I'm going to do a reading of this. I know nobody in our community knows about this yet because I didn't know that was public. Bitcoin, an old dog, but the new frontier. Market potential. Showing the difference between Ethereum and Bitcoin. Transaction throughput comparison. Ethereum 20, MasterCard 5,000 transactions per second, Visa 24,000, Lightning Network 1 million. The future of Bitcoin. Oh, look at this here. With the expected newfound awareness and interest created by the launch of multiple ETFs, who's launching an ETF? BlackRock, Larry Fink. He's running his mouth publicly. They positioned with Coinbase. Coinbase is adding Lightning Network, and Dark Fusion is saying this. With the expected newfound awareness and interest created by the launch of multiple ETFs from the world's largest asset managers, we believe Bitcoin will remain a dominant distributed ledger technology for the foreseeable future. Where other distributed ledgers have experienced saturation and fatigue, we believe Bitcoin is still wide open for market share, growth, and expansion. Furthermore, UTXOs offer a novel way of handling state channels that allows second-layer solutions to execute instantly and reliably, which cannot be realized in account-based ledgers like Solana, Ethereum. Again, they cannot be realized on Solana, Ethereum, and its EVM analogs, but it can here. Dark Fusion has pioneered the first major breakthrough in years on the Bitcoin blockchain. We've created simple contract language, a smart contract modeling language designed for making the development of smart contracts simple and accessible. New developer deployable token standard, decentralized exchange, proprietary wallet, Block Explorer to view and track transactions. So, what is the future of the Lightning Network? Few Layer 2 solutions have created as much buzz as the Lightning Network. Usage statistics highlight growth on the network, yet these statistics are relatively modest when compared to those of even the newest Layer 2 chains on Ethereum. However, Lightning Labs is steadily developing its ecosystem for the future. As a result, the adoption of the Lightning Network has been on the rise. According to 1ml.com, an analytics app on the Lightning Network, there is over 5,400 BTC worth 145 million locked into the Lightning Network. There are nearly 16,400 nodes and 75,700 channels being used, and yet the average transaction cost is 0.0016 Satoshis. That's 0.000043 cents, making it extremely viable for microtransactions. Unlike the initial days of the Lightning Network, there are a handful of wallets that support it, and they are mobile friendly as well. Only a handful of wallets, but you got Dark Fusion launching theirs. I mean, this just launched this past Friday. I got my hands on it. Even though it's beta still right now. Unlike the initial days of the Lightning Network, there are only a handful of wallets that support it, and they are mobile friendly as well. Breeze, Wallet of Satoshi, and Eclair are some wallets that both Android and iOS users can benefit from to transact on Lightning Network. Let me take note of this. Breeze, Wallet of Satoshi, and Eclair. Lightning wallets. Then you're gonna have the Vara wallet. As mentioned earlier, Lightning Labs has expanded the toolkit needed for the developer and user ecosystem on the network. As a result, there are applications across DeFi, liquidity providers, NFTs, and gaming similar to those on the Ethereum blockchain emerging on the Lightning Network too. Cryptocurrency exchanges are also starting to support the protocol, Coinbase, bringing the Lightning Network to as many traders as possible. Exchanges that integrate the Lightning Network allow traders to withdraw smaller amounts of Bitcoin cheaply and instantly. I know one problem that I have with Ethereum is that anytime I do anything with Ethereum, I got to do it in big amounts. I can't do $5 Ethereum or $50 Ethereum or 100 because the fees is almost just as much as what I'm pulling out. I got to do it like $500,000 moves on Ethereum. But with this technology, with Bitcoin and stuff, you can do small amounts. Network stewards called watchtowers protect users from being scammed. Offline transaction scams happen on payment channels when nodes go offline. If the counterparty attempts to close the payment channel to take the funds, the watchtower detects it, freezes the funds of the offline node, and penalizes the malicious party. There is no lack of challenges that the Lightning Network faces, yet the ecosystem is slowly starting to build out for robustness, scalability, and potentially more user-intuitive experiences for the future. All right, that's just confirmation I know I'm on the right path. I just got to keep moving forward. So let me stop sharing screen. That, ladies and gentlemen, is our special crypto talk for today. I hope you learned something new. As always, that's the point. I did. I learned some new things, and I got verification on things that I'm already doing. All that means now is I need to scale myself and do more of it. Timing and positioning is everything, and I'm not missing this time around. So what's going to happen next? Well, if you like my crypto talks and you are not a part of our ILCA community, I do these crypto talks every morning. These are priceless. Then you can be a part. My inner circle is $49 a month. You can be a part of this. Go to ilcasecrets.com/sales page. Then I am in the middle of 5-day challenge I do once a month. Tonight is day 2. I did last night for the public. Tonight is not for the public. Tonight you have to at least register. There's no cost. It still amazes me people are afraid of having to pay for something, but there is no cost to register. ilcachallenge.com. ilcachallenge.com. You can register, and tonight we're going to be talking about blockchain technology, and my special guest is Professor Oscar Sistrunk from Morehouse College. He's going to be talking about something very unique that most people don't get and understand. The Bitcoin halving. why it's important, and how we're going to profit from it. This is why I always say I have a small window of opportunity for wealth generation, for that's generational wealth. We only got about 5 years left to be able to do this the right way. All right, that is it. I'll be back tonight for our 5-day challenge, day 2, 8 p.m. Eastern, 5 p.m. Pacific. If you don't know how to get to it, I got the links right on there, but you can contact my executive assistant, Miss Marnita Casa, or whoever invited you to listen to me today. They'll get you plugged in. With that, enjoy the rest of your day, everybody. Bitcoin Brandon out. Bye-bye.